Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello, my name is Vinay Joseph and I'm the Chief Investment Strategist at Standard Chartered Bank, India. 2022 continues to be defined by high volatility, with escalating geopolitical tensions adding to already increasing worries about inflation and higher interest rate trajectory. The impact of all these headwinds for India is through higher commodity prices and more volatility in asset markets, especially the currency. The likely negative impact of higher commodity prices on India's macroeconomic fundamentals amid continued foreign investor outflows has pressurized Indian assets in 2022. So how do we see asset class performance going ahead? Before delving into that, it's important to analyze the current macroeconomic environment. We continue to expect India's economic growth to remain above its long-term trend in 2022, supported by a low base, government's greater fiscal spend in the budget, and a broad-based economic recovery with a revival in consumption and private capex. However, escalating geopolitical tensions and rising commodity prices are near-term headwinds to the economic growth recovery. In our view, CPI inflation is likely to remain above RBI's medium-term target of 4%, as higher commodity prices, persistent supply issues, and improved pricing power among corporates is likely to exert upward pressure on prices. Altogether, this means that RBI is likely to hike policy rates by around 50 to 75 bps in the second half of 2022 amid rising inflationary pressures and still quite resilient economic growth. Policy normalization by the RBI and US Fed is likely to pressurize interest rates and bond yields in 2022. So given the above macroeconomic backdrop and the volatility we have seen, we believe investors from an asset class outlook is better off by sticking to a diversified asset allocation, which is in line with their risk tolerance, rather than raising cash at the current juncture, as this could hurt your long-term returns given higher inflation and already a significant pullback in risk assets. Those investors who are concerned about further downside, at least in the near term, could hedge by taking a little bit more exposure to gold. Within the asset class, Indian equities remains our most preferred asset class over a 12-month horizon. Strong macro fundamentals, robust earnings expectations, and better valuations post the correction are key drivers for equities. Within equities, we continue to prefer large cap equities over mid cap and small cap equities on relatively better macro fundamentals and a greater margin of safety in terms of earnings and valuations. Our key investment theme, which is India investment revival and broadening value rotation, are continuing to benefit from the current reflationary environment, and we think so this trend will continue. Bonds remain a core holding, as surplus liquidity and attractive yield premiums are counterbalanced by weak fiscal dynamics, worsening government bond demand-supply balance. Additionally, rising interest rates is another headwind for bonds. Within bonds, we maintain our preference for corporate bonds over government bonds, with a tilt to high-yield corporate bonds, given that corporate fundamentals are much better than fiscal fundamentals right now. We also maintain our preference for short maturity bonds over medium and long maturity bonds, given a lot of the interest rate hike has been priced in at that part of the curve. So that's all for today. In case you find this podcast useful, please like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.